Schmidman, shares of Sequential Brands had a great run in 2014. You went from 5 to 13. Now the stock's around 12. What drove your results in 2014?
You know, we had a great year in 2014, and really if you look at Sequential, we're just getting started. And so the year of 2014 was just part of the very beginning chapters of Sequential's transformation from being an old operating company into a new pure play brand management company. And today, through a series of acquisitions as well as organic growth initiatives, we've grown to be a portfolio of 12 brands generating almost $2 billion in global retail sales.
Well, there are high expectations for you here on Wall Street. I think analysts expect you to do 40 cents in earnings. That's up from around 27 cents in 2014. How will you get there?
Yeah, you know, and when you think about our growth trajectory and where we're going, we couldn't be more excited, frankly, Greg. And the reason for that is you have a portfolio of brands which are growing close to 10% a year. And that's through a combination of new category growth, new geography growth, heavy emphasis in international, and a new channel growth, especially in the digital space. When you combine that with the ability to leverage the platform which we've built by adding in new brands into the platform, we see ourselves going up pretty fast.
Well, you already own some great brands, Franklin Mint, Revo sunglasses. When you're looking for acquisitions and people are making rumors that you're going to acquire some companies, maybe even Perry Ellis, you can comment on that. What do you look for?
Yeah, Greg, obviously I can't comment on specific rumors, but I will tell you this. Core to our 3-year plan, absolutely, is to acquire new brands. We believe we can acquire 2 to 3 new brands per year, in fact. And together, when you combine that all into one, today where we're generating, call it 61 to 64 million of royalty revenue is what we're projecting for 2015, and nearly 40 million of EBITDA for 2015, excuse me. We believe in our 3-year plan, we can get to 3.5 billion of retail sales, which would equate to 100 million in royalty, which would then equate to nearly 70 million of EBITDA.
Well, expectations are certainly high, but there are a lot of doubters out there. About 7% of the shares are sold short right now. You have, I think, around 180 million in debt, cash of around 30 million. So there's some worries about your balance sheet. You worried at all?
You know, I'll tell you why we feel great about our balance sheet. In our unique business model of licensing, we are the licensor, we own the brands, and then we license our brands to third-party operators, best-in-class manufacturers, wholesalers, retailers, who then pay us royalties as they operate the businesses and distribute products. So in that transaction, we get what's called guaranteed minimum royalties, and we actually have over $200 million of contractual guaranteed minimum royalties due to our company. So when you talk about our debt load, the reason we're comfortable is because we have these great guarantees up against them, and the people who provide us with our debt financing are incredibly strong partners, Bank of America, GSO Blackstone, on the leverage finance side. So we actually feel real good about our balance sheet and believe there's actually excess capacity if we needed it.
All right, and then finally, are millennials brand loyal? Do they care about brands as much as you and I did when we were kids?
You know, I believe, and we believe at Sequential, that no matter what age you are, brands are important. I have some small little kids at home. I've got a 9-year-old, I've got a 7-year-old. You know, my kids, they love brands, and we love brands, right? You love what you're wearing. This tie, you might not know what brand it is, but trust me, thank you. But when I bought it, I could tell you the brand mattered. So there's an emotional connection from the customer to the product when a brand is introduced. And so whether it's millennials or whether it's an older segment, a younger segment, the idea of having a brand, and that's what we look for. When we look to acquire new brands, we're looking for brands that have affinity, that have awareness, that have, call it a generation or more of marketplace exposure. And then oftentimes those brands, and this is where it gets interesting, Greg, oftentimes those brands get stuck in underperforming operating scenarios. We look to acquire those brands, change the business model into licensing, and then put it back on a growth trajectory.
Thanks a lot, Yehuda.
Thank you.
And thank you for watching The Street.